This conference will now be recorded.
Yes, by that time I think I hopefully now my video is also on and my screen is also being shared.
Yeah, both. Yeah, the slides can be seen as well. Yeah.
Okay. So we are all set then.
So Anand, what we will do is at 5:35 we'll start off. People will join in. People tend to join in a little early, late kinds. So I think we can do that. We can start off by in another 2-3 minutes. And
Okay. Sounds good. Yeah.
so Anand, this is actually a study group. So the whole idea is that we have somebody who will lead the discussion, and then of course we'll invite people's views on the subject as well, because pretty much everyone's in some form of practice, either at industry level or as practitioners, and most of the topics which we have are topics which are pretty live for all of them, and I'm
Right.
sure all of them have their own experiences to share. We always try and ensure it is not a rant session, because these days I think with the tax portal we have enough to complain about, and once we start off it's very difficult to stop. So we try to avoid the rant bit, but yeah, I think experience sharing is something which actually would be possible, because everyone would have had their own share of reassessment cases and some strange experiences which merit sharing with everyone.
Right. I think even I expect it to be more of an interactive session.
Yeah, we should ensure it is one also, because it'll be more fun that way. So, and your slides in
Absolutely.
any case would be shared later on. So, I think the slides can be used more as a guidepost. But we want to hear more of you, and as well as then make it interactive and hear from everyone else.
Right. Thank you.
So Palak, I think we can start off, right? And then I think maybe in another 2 minutes or so, Anand can start on as well. So I
Yes,
think good evening, guys. Good evening, guys. Welcome to the fourth lecture. Okay, sorry, it's not the fourth discussion. I think I should also not use the word lecture. The fourth discussion on the study group, and we have with us today Anand Kankariya. He's a 2010 batch charter accountant. Been with Deloitte for 7 years, been with Rodel Partners, which is a German consulting firm. Before Deloitte, Anand has worked with me as well. The two of us worked together on tax for a while. And so I've actually known Anand for a while, and I can vouch for the fact that here we've got a bright, straightforward, charming professional, sincere beyond doubt, and very self motivated. Also, I think over the years, Anand has been involved in the whole direct tax field, so the advisory, the litigation, as well as the assessment one. So definitely brings a lot of practical experience to the table. So Anand, without much ado, thank you so much for agreeing to present today. It was indeed short notice, so thank you very much for that. And the floor is all yours here.
Thank you, Apurva bhai, for your kind words. I must say that my foundation was built at Rajendra and Company way back in 2010 and 11, and it is perhaps the most memorable time that I've spent professionally to begin my professional career, and I personally owe a lot to you. Thank you for your kind gesture and kind words, and this opportunity to present my thoughts and my knowledge, limited knowledge rather, with the larger audience. Thank you very much. With this, I think let's begin. As you all know, the topic, the current hot topic of the reassessments, the new regime. The whole idea of the new regime, as it started uh, from the fact that the legislature wanted to reduce the litigation and enable and facilitate the ease of doing business for taxpayers in India. Ironically, the story is significantly different just in the first few months of the enactment of the new provisions. So let's quickly get on to the topic. The agenda is I'll briefly discuss the introduction to new regime and the legislative history of the reassessment proceedings under the Income Tax Act, how it evolved, and why now the complete overhaul of the provisions under the Income Tax Act, the rationale behind it, and the new procedure which has been enacted with effect from 1st April 2021, which includes a newly inserted section 148A, which lays down the procedure as such, and the recent controversy. Obviously, the flurry of notices issued over the past few months, which led to filing of a lot of writ petitions across the country, and how does it now proceed from here on. So quickly, introduction of the income escaping assessments. As we all know, these provisions are there since inception, wherein the legislature has empowered the tax department to identify the cases of escapement of income where they could not perhaps lay their hands on at the time of initial assessment, or maybe because there was no filing of tax returns by the taxpayer voluntarily, which then leads to escapement of income. And this is what has been all these years, where these provisions are for the benefit of the tax department, wherein tax officers can go back and assess the income which escaped assessment at the first instance. As far as the legislative history goes, much prior to perhaps the 1996 as well, there were a few amendments, but the significant ones, the important ones, just to set the context, I have tried to capture some of them over the past couple of decades or so. In 1996, as the language of Section 148 read, that the time limit to be granted for filing of tax return in the notice under Section 148 should not be less than 30 days. Some of the notices which actually required the taxpayers to file the tax return within 30 days led to litigation, wherein courts held that within 30 days and not being less than 30 days are not similar, and therefore such notices which required the filing of tax return within 30 days from issuance of such notice, those notices were quashed, and therefore there came in the amendment in 1996, wherein the words not being less than 30 days were omitted. Thereafter, an important amendment which came in 2008, wherein during the pendency of various appeals before tribunals or courts, the similar issue could not be taken up by the assessing officers under the reassessment proceedings, and there were so the notices during the pendency of such cases were challenged before various courts and tribunals, saying that for the respective assessment year there is a appeal which is already pending before the courts, and therefore any notice issued under 148 for the respective assessment year could not be held to be valid. And therefore there came in the amendment which said that only the issue which is pending before the courts could not be taken up under the income escaping assessment, and notices could not be issued under 148. However, for any other issue, the tax authorities were empowered to issue these notices under 148. And then there were another round of litigation with respect to the issuance of notice, the authority who is issuing the notice and the approving authority. Around that topic there were a lot of litigation, wherein a lot of high courts held that where the satisfaction is to be recorded by the joint commissioner, he should have issued the notice himself. Then the clarificatory amendment was made in 2008, wherein it was clarified that JCIT, CIT or CCIT need not issue such notice himself, and the assessing officer is the right authority to who could issue notices under 148. Then the major amendment came in 2009, wherein an explanation was inserted clarifying that that AO was always empowered to examine, assess any issues which he notices during the course of the reassessment proceedings. This came in the backdrop of some of the courts which held that AO could not go beyond the reasons recorded for issuing the notice under 148, and he could not examine any issues which did not come to his notice at the time of issuance of notice under 148. Therefore, the law was amended in 2009 to enable the tax officer, the assessing officer, to expand the scope of reassessment. Then came in some of the amendments in 2012, which were the after effects of the Vodafone ruling, wherein the explanation was inserted, and the scope of reassessment in terms of timelines was expanded, and the income in relation to assets located outside India, failure to furnish the report under 92E with respect to international transactions, etc. All these things were specifically covered under the income escaping assessments. Then 2016, the broad framework to enable and expand the scope of electronic processing of information as far as the reassessment proceedings go. And then 2021, the complete overhaul of the existing provisions, wherein the old provisions cease to exist, which have been now replaced with the entirely newly drafted sections 147, 148, and so on, which come into effect as on 1st April 2021. Now let's quickly get into the new regime, what it is, how it deals with the overall the revamped new proceedings of reassessment. The rationale behind new regime is because that the government has decided to shorten the time limit for reassessments or reopening, which earlier was up to 6 years from the end of the relevant assessment year. Now that has been curtailed to only 3 years from the end of the relevant assessment year, and the need was basis that the entire reassessment proceeding or the reopening proceeding, income escapement proceedings, they all revolve around a basic thing, which is the information in possession of the assessing officer, which comes in at a later point in time after the initial assessment gets over or the time limit for initial assessment gets over, and therefore the officers and the tax department needed some extended time for looking into such cases. Now that with rapidly changing technology and the adoption of the modern technologies by the tax department for collection of information, for gathering of information through various sources such as statement of financial transactions under 285A, 285BB, annual information return, and exchange of information between a lot of law enforcement agencies. The across agencies exchange happens much faster and smoother nowadays, and that's what the that's what the department also thinks now, that the information can be exchanged much faster, and therefore unearthing the escaped income could be done much faster as compared to the earlier era. And therefore, in order to reduce the litigation, to provide ease of doing business to taxpayers, the time limit for reopening and reassessments have been significantly reduced to 3 years from the earlier 6 years regime. What changes predominantly here is the condition or the requirement for AO to record his reasons basis which he believes that the income has escaped assessment, independent application of his mind, and then the satisfaction of the approving authority vis-a-vis the reasons recorded by AO and his belief. These requirements, these conditions seem to have been done away with prima facie from the literal provisions of the newly enacted sections under the new regime as such. That is one of the key highlights. Then there's a new section which has been inserted, section 148A, which prescribes the entire procedure as to how and what needs to be done before the notice under section 148 is issued to the taxpayer. This is somewhat we can relate to, perhaps all of you must be already knowing that Supreme Court in the case of GK and Drive Shaft had laid down certain parameters and procedure along with the timeline wherein the steps post issuance of section 148 to be dealt with. So now the new regime actually makes it objective enough by incorporating the procedure in the act itself by way of insertion of section 148A. We will obviously get into those specific sections as we progress. As I already shared, the time limit has been reduced to 3 years for the normal reopening, and in exceptional circumstances where the AO has in his possession some information, documents, or evidences which suggest that the income which has escaped assessment either in the form of some asset amounting or likely to amount INR 5 million or more has escaped assessment. In such cases, the assessing officer can go beyond 3 years and up to 10 years from the end of the relevant assessment year and reopen the case or reassess the case in such circumstances. This is indirectly replacing the earlier 16 years time frame, which was exceptional. And now there are only 2 time limits under the newly inserted reassessments, up to 3 years and beyond 3 years and within 10 years. To quickly, I think this is self-explanatory. I'll not spend much time on this. I'll just quickly run through. This is a tabular presentation of the comparison between old regime and the new regime, how section 147 provisions required the assessing officer to record his reason. Beyond 4 years, the assessment could not be opened unless there was a failure on part of the assessee. these conditions, these requirements do not find place in the newly enacted section 147. Then 148, again, for issuance of section 148, the prerequisite is compliance of 148A, which was not there as such, while there was guidance of the Supreme Court via GK and Drive Sharp. Then 149, time limits we discussed. 151, now these all the sections may have a mention of specified authority instead of approving authority, which was earlier dealt with by the erstwhile section 151. Now the specified authority is, in case of a less than 3 years, it is PCIT PDIT, CIT DIT. In case of a more than 3 years, it has to be PCCIT and PDGIT. Only in case where there is no jurisdiction as such of a PCCIT, the Principal Chief Commissioner, or Principal Director General of IT, in cases where the reopening is being done beyond 3 years. Only in such exceptional circumstances, the specified authority could be CCIT or DGIT. This is again a broad comparison of how many sections, subsection, explanations, etc. Are part of the new regime vis-a-vis the old regime. Again, just to give a broad perspective, whether on face of it, the new regime appears to be simplified or it is more complex. It gives a glimpse. This tabular comparison gives the glimpse of that aspect as well. Moving on, new procedure and timelines for issuance of the notice. Now, when we look at section 148, it starts with subject to the provisions of 148A. Now, the entire base of the reassessment proceeding now shifts to the precondition to be fulfilled by the assessing officer as prescribed under section 148A, which requires assessing officer to conduct inquiries, to grant opportunity of hearing to taxpayer, gather his reply, and then dispose of the objections, if any, raised by the taxpayer, which used to happen in the erstwhile regime. All of these used to happen post issuance of notice under section 148. So at the first instance, AO had all the liberty to issue 148 and initiate the proceedings under section 147, and taxpayer had to then object to 148, ask for reasons to believe, etc. Now the proceedings have been divided in two parts. There has to be a preliminary inquiry to be done by the tax officer before issuance of notice under section 148. Now section 148 also stipulates that notice cannot be issued unless there is information with the AO which suggests that income has escaped assessment, and it has to be basis the prior approval of the approving authority. Now this information, the new provisions also define such information to mean any information which has been flagged as such by the risk management strategy formulated by CBDT, and any final objection raised by CAG to the effect that assessment has not been done in accordance with the provisions of the ITA as such. So these are very specific provisions which to my mind actually would in a way curtail the scope to some extent as far as the information basis which the reassessment needs to be initiated. First of all, the risk management strategy as flagged by CBDT, it will be obviously computerized, wherein similar to CAS, wherein computer will pick some of the parameters and basis which it will flag whether some escapement has happened or not, and secondly, the objection raised by CAG, that also specifically has to be with respect to assessment has not been done in accordance with the ITA as such. Now, moving on to 148A, the procedure before issuance of section notice under section 148. The AO has to conduct inquiry, as I already mentioned. He has to provide an opportunity of being heard to the assessee by issuing a show cause notice as to why the notice under section 148 need not be issued. The time limit for opportunity not less than 7 days and not more than 30 days. However, basis the application filed by the taxpayer, the AO may use his discretion to and allow extended time to assessee to comply with the show cause notice issued by him. AO has to consider the reply filed by assessee, and basis the reply he has to decide based on the material available on record, including obviously assessee's response to the SCN by passing in order. Just like GK drive shaft, Supreme Court has had mentioned that the order should be speaking order, wherein the AO disposes of the objections raised by the taxpayer pursuant to the reasons provided by him to the taxpayer. Similarly, here 148A says that the AO has to pass an order with prior approval of the specified authority, disposing of the objections, if any, raised by the assessee or the reply filed by the assessee in response to the show cause notice issued. So largely this appears in line with the guidance of Supreme Court. Then the time limits, the important part comes here as far as the time limits are concerned. The AO can't issue notice beyond 3 years once the 3 years have elapsed from the end of the relevant assessment year in a normal course. However, if he has to go beyond 3 years, the provisions are very specific, wherein the income which has escaped assessment has to be in the form of an asset and not any type of income which has escaped assessment. More importantly, it has to be the escaped income has to be of an amount equal to or more than 50 lakh rupees, or the likeliness of the amount escaping assessment has to be 50 lakh or more. And all of this must be basis some books of account or other documents or evidence already in possession with the AO. And therefore, if we compare with the old regime, therefore here again my view is that change of opinion clearly does not would not warrant initiation of reassessment proceedings by the AO, and the ratios laid down under the erstwhile regime would still hold good as far as the change of opinion, etc. is concerned. Then proviso to section 149 prohibits the assessing officer from issuing any notice under 148 wherein relevant assessment year begins on or before the first day of April 2021, that is AY 21-22, or prior years. If the AO has to issue a notice under 148, then it has to test the validity under the old regime vis-a-vis the timelines are concerned under the erstwhile section time limits under section 149(1) clause B, which is 6 years. So even though the new regime allows the tax officer to go back up to 10 years, but for assessment years 2021, 22 and prior years, in my opinion, this proviso restricts it to up to 6 years only. We will certainly look at that subsequently. Critical conditions, as we already discussed, for going beyond 3 years up to 10 years, are books of accounts or other documentary evidences have to be in possession of AO. Income has chargeable to tax must have escaped assessment, which is in the form of an asset, and the monetary threshold of 50 lakh rupees or more. Now there are two things which actually would pop up in anybody's mind when we look at these critical conditions. One is it has to be in the form of an asset. Now, whether any regular disallowance or of incorrect claim of expenditure or any allowance or deduction or exemption has been claimed in an assessment year which is say beyond which is perhaps beyond 3 years from the year which is assessment year which is ongoing, and AO wants to now reopen that case using these provisions. Would that be possible? Apparently no. That unless the escapement of income chargeable to tax is represented in the form of any asset as such, which has been defined under section 149 to mean that immovable property, land or building, shares and securities, loans and advances, and deposits in the bank account. These are the only things that the definition actually includes. However, while defining the asset, it says the asset is defined to include these. Now, someone may perhaps argue that this is an inclusive definition and therefore the specific mention as such are illustrative, and there could be something more than the assets defined as such, but that needs to be tested and deliberated widely before perhaps we could reach to a conclusion whether any other assets beyond these 4 assets included in the definition could also trigger reassessment beyond 3 years and up to 10 years. Then if we look at, if we put these timelines vis-a-vis the respective assessment years, which perhaps could have been opened, reopened, or reassessed under the erstwhile provisions, then we get a lot of interesting answers as to whether the new regime, because of the new regime, could some of the years, interim years, would miss the reassessment window as such. Therefore, I tried to tabulate my understanding of these new provisions in this table. Obviously, as far as the old provisions are concerned, up to March 2020, the earliest assessment year which could have been opened under a normal course of reassessments up to 6 years was AY 1314 and onwards, and therefore I've tried to compare only the assessment years from AY 1314 onwards, and I have not considered the exceptional cases which could be reopened up to 16 years in the erstwhile regime. Income escaping assessment, where the potential income escaping the assessment is less than 5 million INR, that is 50 lakhs. In such cases, under the new regime, obviously, the provisions do not allow the assessing officer to go beyond 3 years, and therefore none of the assessment years from AY 1314 until 1718 could be reopened under the new regime. What if the income exceeded in such cases which is more than INR 5 million. However, the income is not escaping assessment is not represented in the form of an asset. Then in such cases again, the case does not fit under clause B of newly inserted section 149(1)(b), and therefore the assessments could not be reopened or reassessed for assessment years up to AY 17-18. In these two scenarios, under the new regime, AY 18-19 onwards could only be reopened. Then comes the interesting provision of beyond 3 years, wherein income which escaped assessment and represented in the form of asset exceeding INR 5 million could be reopened up to 10 years. When we look at now, as on 1st April 2021, the assessment for AY 13-14 could be reopened because it is within the time limit of 10 years on the face of it. Prima facie, anybody would think that 10 years have not lapsed as such, and therefore AY 13-14 should be eligible for reopening. But when we look at the proviso to section 149(1), the first proviso which I briefly discussed in the earlier slide, I'll quickly jump onto that again, which says that no notice under section 148 shall be issued at any time in a case for relevant assessment year beginning on or before 1st day of April 2021 if such notice could not have been issued at that time on account of being beyond the limit specified under the provisions of clause B of subsection 1 of 149 as they stood immediately before the commencement. Therefore, essentially, in short, what is the proviso says is in cases for AY 21-22 and prior years, the reopening cannot go beyond 6 years because the erstwhile provision did not allow it to go beyond 6 years under those circumstances. And therefore, even under the new regime, the assessing officer cannot go beyond 6 years in cases where the assessment year pertains to AY 21-22 and prior years. Now, therefore, AY 13-14 and AY 14-15 could not be reopened under the erstwhile provisions after 1st April 2021, and therefore, new regime also does not allow it to go back, allow the AO to go back to AY 13-14 and 14-15 as such. And therefore, consequently, only the AY 15-16 and onwards up to AY 17-18 could be reopened under clause B, and AY 18-19 and onwards could be reopened under clause A or B, both. Hope this is clear to everyone. If anybody has any thoughts or instant thoughts with respect to the provisions we discussed, perhaps I'm okay if I'm interrupted while I'm talking. So please do bounce in your thoughts if they are relevant and critical to the ongoing discussion, and if you feel that you may lose the thought or the tempo if it is taken up at a later stage, please feel free to come in. Now, these were the basic provisions as such. Now let's move on to the recent controversy, which has led to flurry of writ petitions being filed before various high courts across the nation, and a lot of them are now lined up for substantive hearing. What happened actually over the past 1.5 years is COVID-19 actually played a large role in various timelines being extended, for compliance as well as completion of various proceedings under the Income Tax Act as such. And before the country went into nationwide lockdown last year on 24th or 25th of March, there were a lot of timelines, statutory timelines, due dates were which were actually falling before 31st March 2020, and therefore, given the situation, it was important for the government also to extend various timelines for compliances and completion of proceedings under the Income Tax Act, and therefore the provisions relating to issuance of notices under Section 148, then section, the old regime, were extended for all those notices which could have been filed from 20th of March 2020 until 31st March 2021. And there were multiple occasions when such timelines were extended from 31st March 2020 to 30th June, then 31st March 21, then 30th April 21, and then eventually 30th June 2021. What happened because of these extensions was that obviously a lot of notices which could have been issued under Section 148 by 31st March 2020 and or by 31st March 2021 eventually got delayed, and the notices got issued post 31st March 2021 and before June 30th 2021. Now when we look at such notices, obviously there was conflict in terms of newly inserted provisions of a new regime which came into effect. The law as such, the income tax law with respect to this provision, came into effect as on 1st April 2021. However, there were other provisions under the Taxation and Other Laws Amendment Act, which was passed, which was notified in the month of September last year, which actually allowed the extension of issuance of notices and other compliances beyond 31st March 2021. So now here is a case where a new provision has been enacted in the law itself by the Parliament, which actually replaced the old provisions of Section 147, 148, 149, and so on, and old provisions ceased to exist as on 1st April 2021, while the Taxation and Other Laws Amendment law, read with the subsequent notifications which were issued extending various timelines, it actually allowed indirectly to keep the old provisions intact up to 30th of June 2021. Therefore, there is obviously a conflict between the act, the provisions enacted by Parliament, vis-a-vis the actions of the executive by way of the delegated powers through Finance Ministry, wherein they issued notifications and extended these timelines. So there was certainly a conflict, and these notices which were issued beyond 1st April 2021 were not in compliance with the newly inserted Section 148A, which actually required the AO to conduct inquiries, grant opportunity of hearing to the taxpayer, etc., and then basis that the notice under Section 148 was to be issued. Now, naturally, that did not happen, and department was of the view that because the time limits for issuance of such notices under the old regime has been extended till 30th June, they proceeded basis the notification. And then came in the flurry of writ petitions filed before various high courts, wherein the taxpayers challenged all such notices basis that the notices issued after 1st April under the old regime are invalid and they are not in compliance with the newly inserted procedure under section 148A. The contention, the arguments of the taxpayer were that the notification cannot override the law which has been enacted by Parliament as such, and executive the powers delegated to executive to deal with the exceptional circumstances cannot override the law passed by the Parliament, and therefore, even though notices issued under Section 148 beyond 1st April 2021 had to be in compliance with the procedure laid down under Section 148A, and therefore they were challenged. The constitutional validity as well was challenged with respect to the notifications which have actually extended these time limits beyond 31st March 2021, bringing in the conflict with the enacted provisions of the law. So, these arguments actually were taken up before various high courts, and large number of high courts have actually stayed all such notices ad interim by granting the ad interim stay all such notices, right from Bombay High Court in Armada D1, Tata Communications, Sahil International, and in fact there are more than 340 writ petitions which are actually pending before the Bombay High Court challenging such notices issued under Section 48. Then Delhi High Court, Calcutta, Karnataka, Madhya Pradesh, Rajasthan, Kerala, all of them actually were in sync with the same thought process, and all of them actually stayed all such notices. However, recently, earlier this month, Chhattisgarh High Court actually pronounced three decisions wherein Chhattisgarh High Court has actually dissented with all other high courts vis-a-vis the validity of these notices. Let's quickly get on to the observations of the Chhattisgarh High Court, why it feels and what is, because it is the only High Court which has actually dissented with the views of other High Courts across the country. Now, Chhattisgarh High Court actually took cognizance of the special circumstances as such, which actually led to these extensions and passing of the Taxation and Other Laws Amendment Act 2020, which the Section 3 actually enabled the executive, the government, to extend time limits after reviewing the situation, and the powers were Parliament actually delegated such powers to Government of India through CBDT, Minister of Finance and CBDT as such, wherein government could extend these time limits using the delegated powers granted by the Parliament under the Taxation and Other Laws Amendment Act 2020. Now, Chhattisgarh High Court actually took reviewed the entire situation, right from the nationwide lockdown, which actually led to extension of timelines for filing of return, assessments, etc. And as the assessee were granted relief, assessees were granted relief for filing return and complying with their obligation to the law, the Chhattisgarh High Court actually looked at the relaxation granted for tax department on the basis of principles of parity, and it said that when the assessee was granted relief, the tax officers also deserved similar relief when they could not take appropriate action to perform their statutory duties under the Act due to lockdown, etc. And considering this complexity, the Parliament has delegated this authority or this power to Minister of Finance, for extension of the date of applicability of these amended section, and therefore Chhattisgarh High Court actually went on to observe that through these powers, delegated powers, the Ministry of Finance has exercised a limited uh, uh, deferment of the enacted provisions in the Act, which is actually not explicit as such, but it is more of the way the Chhattisgarh High Court has interpreted and held it, that such extension actually indirectly extends the applicability of provisions of Section 148 148A until 30th June 2021. High Court also High Court went on to observe uh, uh, the principles laid down by Supreme Court in the case of A.K. Roy, wherein wherein the Supreme Court said that the Constitutional Amendment Act 1978 conferred power on the executive to bring the provisions of that act into force, and it did not suffer from excessive delegation of legislative power, and therefore, owing to the exceptional circumstances, the delegated powers for extension of timelines for compliance of and issuance of such notices is not excessive delegation of legislative power by the parliament. To summarize, actually the observations of Chhattisgarh High Court, it says that it considered the circumstances under which the legislature delegated powers and concluded that notification do not suffer from excessive delegation. Chhattisgarh High Court actually went on to purposive interpretation as against the literal statutory interpretation approach followed by other high courts. Then secondly, it actually interprets applicability of old law based on the principles of parity, as I already mentioned, and then granted benefit to the tax department similar to the benefits granted to taxpayers. So these are the distinguishing things actually Chhattisgarh High Court tried to delve into while taking a dissenting stand. Now there are a lot of professionals who have expressed their views vis-a-vis the decision of Chhattisgarh High Court, wherein many professionals believe that the about decision of Chhattisgarh High Court does not lay down the correct law as such. As far as it neither deliberates nor resolves the conflict between delegated legislation and new law enacted by Finance Act. So obviously, as a settled principle of law, the enacted provisions supersede the delegated enactment or the legislation passed by way of delegated powers by Parliament. So therefore, the new regime effective 1st April, which actually is part of the enacted law, should ideally supersede, and those provisions need to be followed, even if the extended timelines need to be considered. That's what the broader view of the professional is, and I also tend to concur with that view, and therefore the views expressed by Chhattisgarh High Court uh, uh, will have to be seen. How do they pass the test of time, and how they are dealt with when the matter reaches Supreme Court. As based on the news alert of Tax Sutra, I also uh, came to know that the tax department is contemplating to um, file petition before the Supreme Court challenging the observations made by various high courts in favor of the taxpayers. So we'll have to see how does it go. As of now, various high courts have listed all of these matters for hearing towards the end of this month or second week of October. Bombay High Court has actually clubbed all the 340 plus petitions for hearing on 11th October 2021, and wherein the matter will be heard. By that time, the ad interim stay remains, and these notices remain stayed. To put in the perspective, to summarize how these notices uh, stand as of today, I have put it in a tabular format again, which perhaps will give you a bird's eye view. Prior now, notices issued up to 31st March 2021 for AY's assessment years 2013, 14 and subsequent years. Obviously, the legality of these notices is valid, and they fall under old regime because new regime did not kick in as on 31st March 2021. Then comes these highly disputed notices which have been issued between 1st April 2021 until 30th June 2021, wherein notices have been issued for AY 13, 14 and subsequent years. Department believes that they are in accordance with the law, basis the extended timelines notified through various notifications. This is the area of dispute where the legality of these notices have been disputed, and applicability of regime, whether old or new, that is also under dispute. Then come the notices, if any, issued post 1st July 2021. These will strictly be for assessment year 15-16 onwards, as we saw in the table earlier, where I tried to summarize or compare the validity of various notices under the new regime. These will be obviously valid and under new regime. It won't be under the old regime as such. Then what happens? How do we now move forward with these developments? It is very important for taxpayers to initially assess the validity of notice issued by the tax officer under section 148. Very important to see whether there is a appropriate compliance by the tax officer with respect to newly inserted provisions of 148A, etc. And if there is any deficiency technically or procedurally, the notice can be challenged under the writ jurisdiction before the High Court. And if at all there is some compliance is being made by the taxpayer, some replies are being filed, it has to be strictly under protest and without prejudice to the rights and contentions of the taxpayer in this matter. And a prayer may also be added to say that the ratios of as held by various high courts in these writ petitions which are yet to be disposed of finally by various high courts, that needs to be applied. Prayer may be added if at all any reply is being filed before the assessing officer in response to such notices. So these are some of the basic safeguards which assessees can take with respect to such notices and ongoing reassessment matters under new regime. A lot of questions actually pop up in my mind, and I'm sure it would also pop up in the minds of all of you. The first and foremost ironical thought that comes to my mind is the entire intention of new regime was to curb the litigation and uh, facilitate ease of doing business to taxpayers, and as soon as the provisions have been enacted, there's a series of litigation which has actually opened up the controversy uh, even before a lot of assessees and tax professionals could get hold of the new provisions. So ironical, certainly ironical, but then we also need to think about whether the new regime is really going to be better going forward for taxpayers, as the intention of legislature is, uh, but it doesn't seem so at this point in time. Then will the reduced period of reassessment or reopening, will it actually help uh, uh, taxpayers in escaping the potential evasion cases from the tax net or from the radar of tax department, because certainly tax department will not have enough time to go back and dig deeper into the available information or maybe exchange of information as such. But the intention of the legislature is that with robust technological developments and adoption of advanced technologies at the Minister of Finance and CBDT, they believe that they will be able to get hold of the required information much faster and smoother. But only the time will tell, perhaps, because the kind of issues we are facing with the new tax portal uh, and the glitches and the technological disruptions that we are actually facing, uh, it, as of now at least, it raises a big question mark as to how this regime will progress, whether it will serve the intended purpose, or will it actually dilute the the intent and the purpose going forward. Then obviously, the other practical challenges, if any, including the issues at the online portal, which perhaps most of you would already be aware of. um, uh, Maybe many a times I have experienced over the last 2-3 weeks that against many notices, just like the penalty show cause or some other notices, the option or the button to submit response is disabled, and the only option I was left with in such a situation was to exercise the option of seek adjournment or view adjournment. And under that option I had to justify why I am choosing this option on the e-filing portal, because the option to submit the response was disabled, and there was nothing that we could do. We tried a lot of other options to comply with the notices, but something similar could also happen with respect to notices under section 148. And obviously the challenges of the tax portal remain, which need to be seen practically, how they make these assessment proceedings smooth and easy for taxpayer as well as for the department as such. And to say the least, the faceless assessment as well. Uh, the reassessment proceedings under the new regime also will happen under the faceless regime, and therefore, as most of us would have experienced, there are a lot of assessment orders which we received over the past few months. In many cases, the replies filed by the assessees, the submission, detailed submissions, the show cause, the reply to show cause filed by the assessees through e-filing mode have not been considered while passing the assessment order by the faceless team, and many of such notices of demand under 156 and the assessment orders had to be challenged under jurisdiction before the High Court, wherein the apparent uh, what to say the apparent case of ignorance of, or rather not consideration of the various submissions filed by the assessee through the e-filing portal under faceless scheme. So therefore, It is the entire faceless scheme is to my mind, is in a trial phase right now. A lot of other difficulties and challenges are being faced by taxpayers and assessees as far as the faceless proceedings and the portal issues are concerned, and the same will have to be tested, uh, and we'll have to go through that pain for some time, is what I see as far as the reassessment proceedings are concerned as well. So I'll stop here. I finish my part of the discussion. Very happy to discuss these provisions and deliberate, and make it interactive. We have enough time, perhaps, if I'm not wrong. We have some time for further discussion, deliberation, and question and answer, if any.
Thank you, Anand. Thank you very much. Very, very detailed, covered most of the dimensions. So thanks for that. So one of the tips I have been given in the past was that when you get the notice, and obviously the first reaction is this is a wrong notice, and one does tend to actually therefore think more in terms of how do I challenge this notice, etc. I was only advised at one stage to say that if you actually have a case that is really good on merits, you might want to first focus on the merit bit and ensure that that's where the matter ends, because that litigation then will probably stop at the tribunal level. Whereas if you're going to challenge, if you're going to succeed on the technical issue that the notice was invalid, or it was beyond jurisdiction, or somebody was abusing or overusing the power which was not there with them, then that's something which you're probably paving the way for going much higher, particularly if the tax effect is larger. So, I mean, I also tend to, the first reaction almost always is, is this notice valid? And let's look at that first. But I think I've slowly started changing that approach and saying, let me look at, the merits of the case first. Uh, but that approach which I'm taking is slightly wrong, I feel, for the reason that reassessment gives you the right to touch this, and by using this as an alibi, touch everything else as well in the assessment. And that is the risk which you actually do tend to carry. Flip side, of course, is that if I were to if I had to challenge the notice, I would need to go approach the writ courts. I wouldn't be able to do it in the appeal process very easily. I would first need to approach the writ courts, and if I do that, it's possible that the matter actually goes into long-term cold storage, which means I'm sitting on some kind of a overhang thing, which I don't know when this thing is going to get sorted out. Of course, I always have the option of letting the reassessment get done and then challenge the reassessment as a part of the appeal process. In which case, I sometimes have to make a choice between whether to focus on the technical grounds or whether to focus on the merit grounds. So if anyone else has any views on this, I think that's something we should actually discuss. And Anand, one more thing is the reassessment will also be faceless, right? Which means the notice is issued.
Right.
I have a feeling that in the future, the notices will also be issued by the National Assessment Center and not by the jurisdictional AOs, because the data analytic results are going to be fed into a common system, and therefore it's possible that reassessment notices may therefore in the future, and I'm wondering how that will work, because if a notice requires a sanction, then the sanction has to come from a jurisdictional JCIT or a CIT. In which case,
Absolutely.
can you have a notice which is issued by a National Assessment Center, but something which is kind of sanctioned in turn by a JCIT or a CIT, because a JCIT or a CIT would probably need to be jurisdictional, and a jurisdiction less CIT or a JCIT, again possible, but I'm not too sure whether that would be the case. And also, I've been wondering that we are filing our objections actually with the jurisdictional AO. So I'm wondering who's going to deal with the objections. Is it going to be the jurisdictional AO, or he will in turn shift it to faceless, and then the National Assessment Center will deal with the objections as well as with passing of the final order?
Right.
Any
Very,
thoughts,
very,
Anand?
very
Plus,
valid.
if anyone else has any thoughts on this as well.
I'll wait for if anybody wants to speak, and then I'll share my thoughts. Fine. So, Apur bhai, very valid questions and very valid pointers rather, because now that we are seeing in the assessment proceedings which are happening faceless, uh, if we see the chronology, the assessment happens under a faceless route by a national faceless team. The order which has been passed goes back to the jurisdictional AO for rectification, for a stay of demand, and for other proceedings. And simultaneously, if at all that needs to be challenged before CIT appeal, that again goes to under a faceless route. So now, even today, the entire setup, the entire mechanism actually appears as a mix of faceless as well as jurisdictional. So my preliminary thought is perhaps something similar will also happen in the case of reassessment proceedings, where the specific jurisdiction comes in, it will go to the jurisdictional authority as such. This is just a thought. It's still maybe I'm thinking aloud, and maybe basis the jurisdictional thing, perhaps the subsequent process may be done by the faceless team. That's what perhaps I can think of as of now.
Hello, Anand, can I give another issue? Uh, yeah, on another
Yeah,
issue.
please,
Yeah.
please go
Okay.
ahead, Amit.
Yes.
Yeah. Okay. Now if we have a live case. Now this is something like this. Just a quick background. There was this is for AY7. This is for AY 1718. So it's on the borderline one. It's like within 3 years, within 3 years. Okay. So what happened was there was in the AY 1718 there was a proper 143.3 notice scrutiny done, and the order was passed in a not I mean with no major disallowances anything, an order accepted by the SSC. Now this year, this is before just before March, audit team, the internal the IT audit team raised some objections. The specific objection was for disallowance of interest for asset not put to use under the ICDS. There was a big asset of some 100 crores not put to use for 1 year. Basically, asset was capitalized in 16-17 with a loan, but not put to use till 17-18. So interest was disallowed by the SSC voluntarily and capitalized in the IT books, and not capitalized, and not in the financials. So the assessing officer is saying, boss, you'll have to do much more, the entire interest, not the specific interest. Basically, that's the point. That is the audit. Sorry, that's the audit point, not the assessing officer. Sorry, my mistake. That's the auditor's point. He's come with some vague calculation saying, no, this cannot be this calculation. Aapka interest is galat hai, bhai. You have disallowed only the specified interest. You should be the whole interest like that. Now the question here is, can the assessing officer then can the can the audit team then recommend reopening in this case? Because this was gone through, this whole case was scrutinized. These points were all taken up. So now change of opinion. Can this work as a change of opinion case? First of all, and what about time limit? This is for AY 1718. Both questions. Yeah, if you can help me.
Yes, Mr. Kotecha. So first of all, as far as the time limit is concerned, that this is for AY 1718 and the notice has been issued prior to 31st March 2021.
Sorry,
therefore, certainly.
So sorry, one in my interruption. Notice has still not been issued, but he wants, because the amount is below. The amount is about more than 10 crores for the interest portion, the differential interest that he wants to disallow. Okay. So 3 years, of course, no, that is not. He wants to go beyond that 3 years. He has not done it as yet, but that's the news that we are getting informally from the assessing officer. Okay, but this audit team is pressurizing for reopening.
So obviously, now that there is no notice which has been issued until 31st March 2021. Certainly, and it has not been issued until now, as I understand. So the entire, if at all he has to proceed with it, the entire proceeding will fall under the new regime, and therefore beyond 3 years, and within 10 years, the specific critical conditions of, the income escaping has to be represented in the form of asset. It has to be, obviously it is more than 50 lakhs, so that's not an issue. And the AO must have in his position the record or a document or evidence to suggest that income has escaped assessment. All these three conditions have to be cumulatively satisfied. Now here, apparently what I understand is the income which has escaped assessment, whether it is represented in the form of an asset, that apparently looks like the interest portion is being looked at, which
Yeah,
is
yeah. So the trade-off is either interest as an expense allowed or capitalized. Either way, basically the objection is that this interest
right,
should have
right.
been capitalized
So
in the IT block. That's it, but not charged as the revenue, the differential interest.
correct. So I understand obviously that it is capitalized in the assets, fixed assets. But the interesting thing here would be, first is, as far as I am right now, I am on the bare provision as such and not getting into the
Yeah,
role of the audit objection or
correct.
audit query as such. Prima facie, this doesn't seem to be a fit case to my mind, because the cumulative conditions don't seem to be getting ticked off
Fulfilled.
as such.
Yeah,
The only thing is now how the definition of asset is being looked at by the tax officer, and how do we, whether the inclusive definition, whether we do a purposive interpretation there to say that only the four type of assets which have been defined as such
correct. Yeah,
need to be, the underlying income escaping assessment need to fit into any of those,
Mm.
or is it something similar of this kind could also be, you know uh, could also be caught into the new regime.
yes,
To my mind,
correct.
apparently this doesn't seem to be a fit case. This is beyond 3 years, and the critical conditions don't seem to have fulfilled. As far as the audit objection part is concerned, uh, certainly the independent application of mind of the officer, what reply he has furnished to the audit party as part of his own defense to the audit objection for his earlier assessment, etc. All of that needs to be obviously looked into. And
But
as,
I mean, just to interrupt. Sorry, just to interrupt. Practically, naturally, you know how this works. I mean, we are. I mean,
yeah,
giving the reply. As if the audit officer, poor guy, doesn't know what's going on. So he is just helping him to reply to the audit objection directly. So that's where we are being a little
I
careful.
know, and in my experience, most of the cases, the officer has to obviously object to the audit party's
Yeah, yeah,
observation.
yeah, yeah.
You're only
And
helping. I think it's the help me to
yeah,
help you kind.
Yeah,
I
yeah,
think
yeah,
I'm
yeah.
happy to help him because if I provide him with the ammunition, he can shoot on the basis of that and prevent me from further damage.
Yeah, that's what.
actually.
Yeah,
But
Therefore,
Anand,
and
so
therefore,
Anand, yeah. So Anand, I'm
yes, Apurva.
just two things I was wondering. One is, we have this whole plethora of case laws which deals with reassessment based on audit objection, and
yeah,
the predominant view is
correct.
actually that if it is audit objection based, then in that case you don't have a right to reassess.
Yes,
Obviously, the
yeah, that, yeah,
logic obviously being that if it's an audit objection, it's not any new material, but somebody is just sitting and re-looking at the same data. Uh,
yeah.
and of course, what is being increasingly told now is that you need to have some, like if you were to challenge this in a writ court, I think they are typically asking you for some kind of evidence to explain why you believe it was an audit objection. And unfortunately, what happens is that all the data which we have about audit objection is all off the record. Some of it is shared on WhatsApp. Sometimes it's
Yeah,
on
yeah,
phone calls or something. So it's getting a little
Yeah,
difficult to. I mean, while I will allege that it's based on an audit objection, it is sometimes a little more difficult to prove it. But Anand, what I'm wondering is that in the new scheme, where this whole concept of adequate reason to believe is kind of being slowly replaced by a slightly different concept. I'm wondering whether this whole plethora of case laws would still be as relevant and as applicable.
First
One
of
would,
all,
of course, typically think that under the new scheme, actually, audit objection can't even be the reason for a reassessment, because typically the reassessments are supposed to come from the data analytic data bank and really not from data which is fed in by the audit objection team.
yeah,
Yeah.
the definition of information, they have also included, the audit query raised by CAG, but it has to be the way I interpret the definition of information, which can lead to reassessment. First is obviously the risk parameters as flagged by the risk assessment system developed by Security, and secondly the audit by CAG. But the in the important part of the definition that perhaps to my mind is that it says, if I were to read just a moment, it says that the CAG objection uh, has to be to the effect that assessment has not been done in accordance with
With the ITA.
the provisions of ITA.
Yeah.
Now, this is perhaps much wider. Uh, it is. It has to be seen how do they deal with it. That audit objection is now has to be linked with whether the assessment is in accordance with the provisions of the IT or not. The erstwhile assessment, which has actually led to the audit query being raised and complied with by the assessing officer. Barring, I mean, apart from that, obviously in the erstwhile provisions, wherever there used to be audit objection, that the entire communication is off the record and the entire documentation is part of the internal files of the AO. But what we did in the past in such situation is we actually wrote a formal letter to the assessing officer stating that kindly let us know whether the issue being now reassessed or re-examined, whether there was any audit objection as such raised by the audit party, and if any, kindly provide a copy of the same to us. Obviously, it's a plain vanilla letter wherein you are requesting officer to be fully transparent with you and share the underlying data. But to put it on record, wherever we knew for sure there is an audit objection and we were party to that, we put it on record requesting the AO to let us know such information, whether there is any, and provide those documents to us. The other option we explored or we deliberated was, can we then file application under right to information? Under RTI, we filed the application to the and obtain the internal case records of the assessing officer, wherein then we can find out whether there is any exchange of information documents vis-a-vis the audit objection has been raised, and where we specifically asked the reply filed by the assessing officer in response to the audit query raised by the audit party. There actually the battle is mostly won, because generally the AO obviously as a defendant in that case does not agree to the audit objection, and he actually indirectly portrays our side of the story. And then basis that the matter can be then litigated.
So the same AO is changing his opinion twice. He is first opining that what he's
absolutely. Then
he's done is correct.
Then it is absolutely
actually now and is now recording a reason saying what I did was wrong. So, but this is actually the advice we've also been given by law firms, saying that you ask for an inspection of records, try and make the request very benign, so that it typically gets kind of accepted, and then when you inspect the records, you might get it. My personal view, of course, has been that the minute I file a letter like that, it's possible that the file may not necessarily stay intact by the time it is shown to me, unless there is a recording on the order sheet, which then cannot be changed. Like if something to do with the audit objection is kind of recorded on the order sheet, then in that case, yes, the AO might actually fall into that trap. On a lighter note, I was also told that what you should do is it should be like a lightning strike, saying you go with the letter to the AO and you don't give him notice, and you reach his office with that letter and ask for an immediate inspection. Of course, my practical experience has been it's very easy for an AO to tell you not today, baad mein aana, abhi time nahi hai, kinds. And obviously, this has been tried and tested too many times. I think AOs would be sharp enough to kind of know that the reason you're asking for this is whatever. I mean, it is to ultimately ask for a quashing of the proceedings.
Hello, sir. CS Suman here.
Right.
Can I ask one small question?
Sure, ma'am.
Yeah,
Go
am I
ahead.
audible? Yeah. So mine client is a salaried person, and in AY 1314 he switched companies. So last year we got notice under section 148 that income has escaped assessment. So he paid taxes with interest, and now he has got a faceless assessment notice under section 142, and they are asking for bank statements, credit card statements, and his job offer letter, form 16, everything. My client doesn't have bank statement and credit card statements. He contacted to bank as well, but they said there is some difficulty. He is now out of India. So what we can do in that case? It is assessment year 1314 notice we have received now.
I think now what I understand is 148 notice was issued obviously earlier, which has not been objected to, and now pursuant to 148, now the officer seems to have initiated the regular assessment for a regular reassessment rather for
Yes.
AY 1314,
Yes, sir.
and therefore 142 notice has been issued. So obviously uh, uh, there are multiple things. One is first, obviously, as the taxpayer has already deposited the additional tax, which perhaps he has not discharged at the time of original return. Uh, I assume that it is on account of switching of companies, and therefore the double deduction has been claimed in both the
He has not filed.
employers.
He has not filed that time, sir. He has missed filing ITR. He has not filed that time.
Oh, okay. Okay. And therefore, did not discharge the additional liability which perhaps would have
Yes.
arose, which could have, arisen at that point in time because of switching. Okay, understood. So now that in response to notice under 148, your client must have filed a return of income, right?
Yes, sir.
Disclosing of all the income and discharging the tax liability on it.
Yes.
Now it is I think a matter of a routine assessment which is now actually happening, wherein pursuant to the tax return, the assessing officer wants to assess that tax return and he's asking for information and documents in support of the return file, which I think in the normal course needs to be complied with, isn't it? The information being asked for, if there is really a difficulty in gathering the information as of now because of his overseas travel, etc. Additional time may be requested to the tax officer from the tax officer for gathering such information and furnishing it before the officer, or maybe under the faceless scheme, wherever. I assume that this notice, if at all this notice was issued last year, isn't it? If in terms of timelines, if you can look at, the assessing officer still would have enough time for passing the final assessment order, and therefore I don't think there should be any issue for asking additional time, and for AO also to grant the additional time in such case for furnishing the required information.
Okay, sir. Thank you.
I, for one, felt very strongly about this whole spate of notices which were issued in the last week of March. I thought that was actually it sent across a very poor signal, because what you landed up saying is that, okay, so the legislature, in the fitness of things and for the reasons which they documented, saying we want to reduce litigation and we now have access to data analytics and all of it, thought it fit to curtail the period. And the tax officers felt that, listen, if that's what you're going to do, I still have one more chance and I want to make the most of that chance. And I think I have seen notices issued left, right, and center. I am waiting for reasons to figure out what is it that was. I mean, I some of the reasons we received were ridiculous, and one could very easily make out that these reasons were recorded in an absolute rush. One of the cases, in fact, when we were objecting, we actually had to write saying, if only you read the reasons again, just reading the reasons again, you would realize that there is no income which has escaped assessment because you're not even bringing the case out. If there is some ridiculous statement which is made on the basis of, so it very clearly shows that an assessing officer, I think, was gunpointed. He recorded the reasons within the shortest of time, probably got approval within the shortest time, and issued it out. Probably because there was, again, a number game kind of a pressure saying, you'll be marked in terms of how many notices you issue out. And we have had cases where multiple years have been taken up for reassessment. And of course, it's taking them a lot of time to provide the reasons. And I'm really wondering what is it that they have really found for so many years. I think it was just one of those rebellion acts saying, "Was sab kar do, last chance hai, just go ahead and issue all the notice." I think it
Too
felt very
many.
bad. I think it felt very bad as an assessee to receive these kind of notices because you really felt that the change in legislation was actually taken very badly by the revenue.
Department.
But
Too
when an
many
assessee does
changes.
the same thing, it's not accepted. So
Yeah, I think too many powers being removed from the department in 1 year, everything making faceless right up to the tribunal. So too many things being removed at one shot. I don't think they expected such a lot. And then on top of that, this cherry on the cake, 3 years only, like nothing doing all out. So what did you expect?
there was
This,
feeling of insecurity, in a feeling of
yes.
insecurity kind of setting.
And I have, in fact, I can relate to these experiences, Apurva bhai, in the past as well. I mean, this is the time when the entire code of reassessment is getting revamped. But in the past as well, in one of the leading software, the leading banks, the UK banks, we when we dug deeper into the internal approval process, etc., followed by the AO for issue before issuing 148, we realized when we got hold of the documents and when we plotted it on the timeline, we realized that that the reasons were recorded on a particular date by the assessing officer, and approval was obtained prior to recording those reasons, wherein the the law requires the approving authority to record satisfaction vis-a-vis the reasons recorded by the assessing officer, and the approving authority actually recorded satisfaction based on the internal note, the case note that was prepared and was shared with the commissioner. Basis that commissioner recorded satisfaction and gave approval, and then AO recorded reasons thereafter. So that's a very technically the very soft issue which we could target and challenge the validity of the notice itself. So a lot of times the department internally does a lot of hodgepodge because they feel that many of these records are internal, they need not be shared with the assessee and they not perhaps surface in the litigation as such. But wherever possible, we try to ask for the internal documents, especially when we demanded for reasons recorded, approval granted, and so on. So these are, I think, department still does a lot of things at the last moment and in rush of timelines, and, which actually helps us find some loopholes and challenge such proceedings.
Also, I personally also feel that there is a whole plethora of jurisprudence on reassessment, and it has evolved substantially over the last 10-15 years. But despite this, the casual approach which is followed by assessing officers while selecting cases for reassessment And for dealing with the cases, even after the notice is issued, the way they deal with objections, the way they don't deal with objections, means you sometimes wonder that with so much of jurisprudence, I mean, so many cases, CIT appeal, ITAT, High Court, cancelling reassessments, you still step into make the same mistakes. You still record reasons in a casual way. You still don't deal with objections. You still go ahead with reassessments any which way you want. It's really surprising, you know. I mean, so okay, so it's not really surprising because I think we are used to officers not being adequately accountable sometimes. And I think also sometimes it is the audit objection pressure where, you know, they are kind of just forced to issue the notices out, and it's done in a half-baked way. But I have always felt that reassessment is something that is far more serious than a routine assessment. And you're actually making an allegation against somebody saying that you have actually income which has escaped assessment. And I think it deserves a certain kind of dignity and a certain kind of seriousness. And somehow, the way reasons are recorded, I think you always feel that there is a lot which is left wanting. I think it doesn't ever, very rarely does it show that kind of seriousness which makes you feel that, okay, here was really a case where income had escaped assessment and the assessing officer has really made an effort to build a case.
Absolutely. And in fact, Apurva, as now we are discussing a lot about the assessments, another case which comes to my mind is one of the cases under 263 which I dealt with. Again, a person at a commissioner level, how can he leave such? I mean, how can he draft a notice so casually? In the notice under 263, while issuing the notice, the CIT in the first opening para makes a mention that based on the proposal forwarded by DCIT, so and so has been done. So I mean, independent. There is a long history of such matters wherein independent application of mind has been, been said to be the prerequisite and all of it. And a person at a commissioner level, while issuing the notice in the opening para, I mean, it was an open and shut case in the tribunal for us. Just the opening para we read and that's it. The case was shut. I mean, even at the commissioner level, we see such casual approach and casual behavior, let alone the AOs.
We are still all hoping that faceless will change, hopefully, some of this. I think fingers crossed.
Yeah, absolutely. Fingers crossed, because we in our recent experience faced a couple of cases where our replies and submissions, point by point submissions and replies which were uploaded, the faceless team passed an order making a blatant statement saying that there was no information which was furnished and documents were not submitted in this particular notice. I mean, it is on a digital record. I could have understood that had it been in a physical file or somewhere, perhaps there was a miss out. It's a digital record on the portal in a faceless way, and still they are making these. So certainly there is a long way to go.
But just to add to Mr. Anand's point, Purva, I'll just tell you one small little thing on this. Is of course not relating to the current topic. It's about faceless. I told you about my audit objection, and in the same line we had a regular assessment faceless, a faceless regular assessment. There were 2 points for disallowance. One expenditure was of 5 lakh rupees, which was an expenditure which was written off by the SSC, by us, written off for work not done by the person. Means the person was paid 5 lakhs, tax was TDS, and work was not done. So that also the faceless guy is saying, sorry, you don't have enough proof to recover the money. You didn't make enough efforts to recover. I don't know what world is, which decade is living in. That's fine. So we accepted it. I mean, we had a letter from that person who had got the 5 lakhs saying that I've shown this as part of my income. And yes, the work could not be done for a reason, and we cancelled the whole project for which it was paid was not viable, so it's mutually cancelled and done. Anyway, that's fine. We accepted that. The bigger, the funnier part was 25 lakhs. There was an amount paid by 25 lakhs by this SSC without deducting tax, and the amount was written off as a revenue expenditure. So it was paid as an advance at that point of time. No tax deduction happened. Nothing. And the SSC had written a few letters to that person saying, threatening him with legal consequences. allowed by the faceless. No problems. 25 lakhs. You have made some effort. This is just to add to your point about faceless. I don't have too much hope about faceless. This is just lie. I'm talking of 2 months back. I've got the order. 25 lakhs
You can
allowed.
say
No
that
problems.
your faith in luck must still stay
Yeah.
intact, because
Yes.
you will,
Exactly.
at the end of it, I think even faceless is at the end of it done by humans.
Yeah.
And even if it is done by algorithms, the algorithms are made by humans. So I
Yeah.
think as
No,
infallible as we always were.
correct. But I was under the impression the faceless
So
before the
so
before
so
the order was
so
passed is to be discussed by the committee, right? But there's a committee. I believe there's some committee because I'm in industry actually. Technically, these both cases I have enumerated are with our group companies. So I'm just wondering how this the committee that was supposed to vet the order before passed of this 25 lakhs, because there was a whole back and forth on this 25 lakhs thing, back and forth like 3-4 times. We were telling them sorry we couldn't recover it and all that. No tax deducted, nothing. He said, fine, you just made some little effort and we accept your contribution. But 5 lakhs, sorry, boss. You didn't write anything to him, so it's disallowed. And not only that, he issued SCN penalty also for that, under the new 270A, that the new penalty for disallowance, 50% of the tax.
So Anand, this can be a case where a reassessment could be possible within 3 years, right?
I know that is what we are more worried
yeah.
about. That's what we are technically worried about. So we're keeping very quiet and we're going to accept that 5 lakhs and just keep quiet. But
So
just
just slightly deviating from the topic,
yeah.
last couple of weeks, I mean, whenever I am getting an opportunity to meet the professionals who are predominantly into litigation and counsels, there is a chatter going on wherein a lot of people suspect that there is a this is a orchestrated entire episode from the department insiders, that they are not letting the faceless succeed, or they're perhaps they're intentionally being uh, mishandled or something like that.
With this
And even the
with this
portal
order that I've received, I can agree
portal
with this view. Anand, with the order that we received, we have had a good laugh over it
because
for over so many drinks.
faceless is actually has shut shops now for them.
Yeah, exactly. That's no. We are prepared for 25 lakhs being disallowed completely. We are prepared to pay the 50% penalty extra XYZ, and we got this order as the icing on the cake. So I agree with Anand. I think there seems to be some design to let it fail completely. Disaster.
Do
Anyway,
we have anyone else? Anyone else has any views they'd like to express on reassessments, or any questions, or any areas which we can discuss with Anand? Or Anand, do you have any closing thoughts before I can hand over to Palak to give her closing thoughts and to give you a deserved vote of thanks?
Just thank you for this opportunity. Being in Pune, I think technology has helped us connect across borders, across cities, across jurisdictions. And now with faceless assessments, we are still able to at least do some face to face some interaction over the digital mode. And I never imagined that I could be speaking in a study circle group or facilitating a discussion sitting here in Pune and participating in Mumbai. So very fortunate to have worked with you to get this opportunity and share my thoughts, and very wonderful experience. Thank you very much.
Anand, thank you very much on behalf of the WIRC and on behalf of the study group and all of us here. Thanks for taking the time out. It takes a lot of effort to make a detailed presentation and share all your thoughts, and within the short time we gave to you. Thank you very much. We hope to see you again soon on this platform at some stage. And thank you everyone else as well. We will have another session next month. We'll share the details with you. If anybody has any topics they feel we should take up, we are happy to have you post that on WhatsApp. Also to remind you that you could also be a leader and you could also volunteer to present. So give it a chance as well. I think it's a good experience. And Anand, thank you once again. Have a good evening. Have a good weekend. Bye.
Thank you,
Bye.
Apurva bhai. Bye.
Thank you.
Take care.
Bye all. Bye.
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 Bye.